The Rebel Capitalist Show.
With the Constitution and, we the people, is it just other citizens are being sheep-like and like there's, I can't understand, if you've got a Constitution, you can't mandate vaccines and you can't tell people or businesses what to do.
They try. Yeah, they try.
But it's against the Constitution, no?
Well, that's what they're doing. So basically what happened is the Biden administration came out with this mandate for businesses of over 100 people to require that their employees have the shot. We'll call it the medicine to keep it YouTube friendly. And this is being held up in a lot of the district courts because a lot of businesses and other entities are pushing back, saying, no, this is not constitutional. And that's pretty much what the courts are saying right now. It could have been just theatrics by the Biden administration because they thought that policy would poll well, but they knew that it might not go into effect. But a lot of the businesses preemptively did this, and it's, forced a lot of Americans to quit. And I don't know if you followed the statistics in the US lately, but the rate of people retiring is at an all-time high. And instead of the Great Recession, they're calling it the Great Resignation.
Yeah, I think that's a global thing. I'm seeing that everywhere. And of course, it's opening itself up to this debate about the great inflation or otherwise, Remember, I published a paper March, last year anyway. My paper on heavens, I can't even, George, honestly, my brain these days is so frazzled. But what was my damn paper? I mean, I don't write them that often. But anyway, it was about inflation, etc. But I was saying that people say inflation is a monetary phenomenon, and that is correct. Yeah. And I'm kind of, I'm not really buying into the hype of the persistence of the higher prices owing to the absence of that phenomena that we call monetary. But I added a caveat saying, actually, for these breakout series where you get an eruption in all prices, it's actually a function of psychology, of the psychology of society changes. And of course, we have to go back 100 years, if not more, to actually experience such breakouts, such enormous negative energy, if you will, within society. And it's I would maintain that its root is division. It's when I really don't like you, that I never like this term hate. There's no comeback from that. This is such an absolute appalling kind of term, but society becomes divisive and citizens saying, I hate you. And everywhere I look, I'm seeing divisions. And even with the medicine, am I right in saying it's kind of 50-50 in terms of those who have adopted versus those who haven't? Or am I underestimating those who have taken the medicine?
Yeah, so in the United States, as far as the adult population, you're getting close to 70%.
70. Okay.
But I would argue that just because someone has made that choice, it doesn't necessarily mean that they think it should be mandatory. That it should be, I think a lot of people that have chosen that, they look at their own personal risk reward and they say, okay, well, I think this makes sense for me. And, but I don't think it, I'm not going to impose my view on my own personal health to others that might be in a completely different place. As an example, I'm some 70-year-old guy that weighs 350 pounds and has asthma. Okay, that's a much different risk reward than an 18-year-old kid that's a triathlete. And I think most people recognize that. But I was listening to an interview with my friend, Dr. Chris Martenson, and another doctor out of Denmark, and I don't recall his name, but he was an expert psychologist and I believe statistician. And it's his view that there's 20 or 30% of people that will just go along with quite literally anything the government says because it's kind of been a religion, or it's become a religion for them. that they just agree to it blindly, because if they don't, they have this kind of cognitive dissonance. And then you've got 20% of the people that would probably fall into your category and my category, where we're highly suspicious of the government, and we value freedom probably a lot more than we value safety, just because we're students of history. And then you've got the 60% in the middle that could they're on the fence. And I think a lot that 60% in the middle, especially if their job has required it, maybe they work for the airline, maybe they work for the government, they're like, I'm not going to really cause a fuss. The downside's very small for me, so I'm going to go ahead and get the medicine. But maybe I wouldn't have otherwise. But they don't believe in that mandate. I think that's where a lot of people draw a line, and that was where I drew the line for myself. As far as I was committing a lot of time and mental bandwidth to the whiteboard videos, but when they came out with that mandate, I started really putting a lot of time and energy into the Rebel Capitalist channel. So I've got two of them, the George Gammon channel and the Rebel Capitalist channel. And that's where I talk a lot more about freedom and liberty, and this kind of push towards authoritarianism that we're seeing in the world today. So that's kind of, I think, how it's playing out in the United States. But I'd like to get your opinion on how this is playing out in Europe. You spend a lot more time there, and it seems like they're really, really pushing back, or at least a vocal minority. Maybe they're a vocal majority, I don't know. But with these protests that we're seeing in Austria, in Germany, I know there's a big one in Croatia. I think there was one in Denmark as well.
Well, but they're only reported. They're only reported on Twitter.
Right.
They are absolutely not being reported in the general media. I don't spend much time in Europe, but I spend much time virtually in terms of reading the newspapers and keeping abreast of those trends. I would not pretend to be, on the ground. Far from it. I have to say, who cares about markets? My biggest fear is being mandated to for someone from the government to approach me with a medicine and inject it against my wishes. That is now going to become a reality in Austria.
Yeah.
And further afield, everything with the A's, we've discussed America. Austria, of course, is putting financial penalties, which seem kind of onerous. I think they ratchet up quite quickly, quarterly, to about 3,000 euros, and don't stop. I'm sure, like a lot of your viewers, we watched in horror about these gulag camps in Australia.
Right.
The track and trace thing, where you're just lifted from your community and put into a bungalow prison for 14 days.
Yeah. Even if you've been in close contact, Hugh, it's not even testing
if you
positive.
Produce is it a positive, like a positive test verifying that you are still subject to that impounding,
or if you've been in close proximity. So let's say
that's what takes you. Yeah. That's the metric. And of course it's CCTV. They're using the license plates, etc. to take. It's the sum of all of my fears. So I live in, as you know, a bubble. I live in a beautiful bubble. I live in an outpost of Europe, an outpost of France in the Caribbean called St. Bart's. And personally, this has been a difficult year, George. I've missed you. When you were here last year, it was fun. This year has felt like a year of going sideways. I've had problems with my a large real estate project. Yep. My budget is coming in 2x, and it's coming in with a 6-month delay. And I thought I'd be opening this Christmas, and believe me, the market is hot to trot, and I'm missing it all. And
is that because of the labor shortages and the supply chain, the inflation that we're seeing domestically in the States? That spillover, or is that regulatory?
It's not. No, it's a function of. Hey, I'm on it. This island is 11 kilometers. 11 kilometers, people. It's nothing.
Yeah,
the fact that I have the audacity to build a $12-13 million property in this speck in the middle of nowhere says it all. And of course, you can't demand that you have the best in class agents to work on you. I'm the principal. Like in all walks of life, I require agents to follow my instruction, and you don't get it. You know,
subcontractors. So it's not that. I know when I was there, you were dealing with some bureaucratic issues and some red tape that was pretty thick.
Yeah, they're still there, but the viewers don't really want to be detained by this, but I kind of speak French and they kind of speak English, and the difference has cost me $3 million. So this morning I spent an hour or so holding a meeting with my cleaning ladies. So you want to talk about? This isn't inflation. This is simply the cost of living here is absurdly high. Would you believe I've got two young, nice girls, and they are obliged, if you will, to work 4 hours a day, every day, for, I want to say, no more than 30 weeks, 30 out of 52. So, just over 60% of the year. And for their endeavors, which I appreciate enormously, I pay them the best part of $45,000 each.
Yeah.
And they were just telling me it is not enough. And it's like, I'm not doing that. It's outrageous. You ask us to do your own laundry. I'm like, really? So in some respects, and we may go on and talk about China and the world at large, over and beyond the damn issue about the medicine. I kind of feel like I want to get back involved in markets, because I'm up to here dealing with cleaning ladies on 45,000 bitching to me. So anyway,
but see, you're talking about that at a micro level, but that's kind of indicative of maybe for different reasons. But it's what we're seeing play out in the United States on a large scale. That these people are just this great resignation. They're putting, they're giving their papers saying I quit, or I need a lot more money to do this job. And I think that's one of the reasons we're seeing these supply shortages and the supply chain disruptions in the United States. And, a lot of, and they probably didn't see this in St. Bart, so I don't know what the French government did, but here in the United States, Hugh, they gave everyone not only stimulus checks, but these PPP loans that they basically didn't have to pay back. And I pulled out a chart the other day for one of my whiteboard videos that I got from my good buddy, Joseph Wang. And it was kind of a breakdown of M2 money supply in the US. But this was specifically the checking accounts for households in aggregate total. All right. Going into 2020, it was about 1.2 trillion. Today, it's 3.6. 3.6 trillion. So you have an increase of $2.4 trillion, plus you've got stock market at all-time high, plus the market cap of cryptocurrency, which I think is having a big impact, is now well north of $2 trillion. So you put all these things together and you can see why you're getting this great resignation, which is leading to all these labor shortages. And then that leads to the supply chain disruptions and the shortages of goods in the grocery store. I know you've spent a lot of time in the United States, but if you came back now, I think your mind would be blown from the standpoint of you go into a lot of these large grocery stores, like the Whole Foods right across the street from my condo, and 20% of the shelves are barren. Nothing. And that business model well. How narrow their margins are.
That is remarkable. Here I am again on this tiny volcanic rock in the Caribbean, and we are, stuffed by European bureaucracy. The food has to be imported from Europe. Comes, and it's a French supermarket, Marché Ou, and everything is well stocked.
Yeah.
So, and there you are. in the largest economy in the world, and there are shortages.
Yeah, I think it would really blow your mind. But when you look at what's happening with these mandates, let's go back to that a moment. Let's look at that through the lens of macro, because obviously you're one of the top macro thinkers in the world. And so let's just put our personal opinion on whether that's right or wrong aside. Just knowing that this is the direction governments are going in Europe and potentially in the United States, definitely in Canada, and then in Australia, how does that impact the global economy?
How does it impact the global economy? I maintain that it reinforces the status quo which we have lived with in risk or capital markets, which is universal. That's from US government bonds to junk bond yields to equities to the currency market. And that status quo has persisted since it's the aftermath of the great financial crisis of 2008. Right. I'm sure I annoy a lot of people when I say that I do not pick fights with where the market is presently priced.
Right.
I saw this week in one of the major the Financial Times, they had an opinion piece by one of the world's great investors. So great, I can't remember his name, but with riches and talent that overwhelmed me.
Like Dalio or something.
No, it wasn't Dalio. It was I think private equity guy. It's annoying. I should have it. But he was saying, markets are crazy, and people are allocating more to these risky markets, and this just seems ill-founded. And I was just like disagreeing with everything he was saying, but maybe that's, hey, I'm in St. Boris and he's in the Hamptons, so whatever. But so what was my point? My point, and to your point of these mandates, the effect on the economy, I do not believe they're making the economy better. I do not believe they're making it easier for the economy to escape this trap. We're trapped in mediocrity where everything is kind of beige. Nothing is really hot. Nothing is really desperately bad. Everything is kind of beige. The shortages, the great resignation, the people who have, if you will, withdrawn their services and their talent from the labor pool. My point on that is they're demanding more. Yeah, to come back. A bit like the conversation I had with my cleaning ladies. And entrepreneurs are going, with the situation with the medicine, people are going, I'm just not ready. I don't trust that in 6 months' time, we don't have another variation or like different part of the Greek alphabet raining down on us and having a closure. And it's a bit like businesses today are a bit like sports franchises where you bring in the next star and he wants like 2x what everyone else in the team is getting.
Right.
And so you got to think long and hard, because in accepting that new talent, which you need, you're kind of going to reprice everything up to the new entrant.
Yeah.
And yet there's certainly not the certainty that, why would you have certainty? Why would you take on a structurally higher labor cost when there is, what is the evidence that the economy next year is going to be on fire to the upside? Where is that evidence? So entrepreneurs are going, no, I'm going to wait. Like people filling the gas in their cars. You wait, I don't know what's happening in the US, but in Europe, when the poor folk come, if God forbid we get a really cold winter, because people are really going to struggle to heat their homes.
Yeah, right.
Now they're going to manage, but that is non-discretionary. And so the budget that's left over for the nice things, well, the nice things, they're not going to happen, right? So I think entrepreneurs are kind of still going, this is a show me economy. Show me. You know, if we go through the winter months and my thesis is wrong and the boys and girls that like pizza are continuing to order pizza, they can't get enough pizza and I don't have enough staff, you know what? Reluctantly, maybe I will accept it.
Right.
Today, yeah, I'm going to show me what happens. I think is what's happening. And so in a world which is still predominantly, and I know the future, by definition, the future is uncertain, but in a world where we have had mediocre growth in terms of like, we've got, you know, so recoveries now are just that GDP is higher than where you went in. And it's a fraud. It's a government cultural fraud, because actually it's not a recovery until you hit the previous trend profile. And we're leveling up, we're leaving trend and we're calling that a recovery.
Yeah, right.
And then we get another issue and then we rally to less and less. This is a depression.
Yeah,
well done, Emil Kalioski with Jeff Snider in calling it. This is again, like the medicine. The media have been trained not to use the D word, the depression word. No, yeah. You're not allowed to use it, you know. So in that world, rational money managers responsible for billions, if not trillions, are kind of saying, I don't get paid enough. I mean, I know they get paid a lot, but I don't get paid enough to open myself up to big risk. In a world where, remember, let's go back to 1997, 98, you know, the Asian tiger and the Russian devalues, okay? So that is 30 years. You've got, that's, I want to, because 97, forgive me, that's 20 years. I'm useless with mathematics. That's 22, 23 years. And let's count the 1 in 100 year, like meteorites, which have hit capital markets. Well, you know, the Asian tiger crisis, the LTCM crisis, the NASDAQ collapse, 2008, the European government, you know, the Greek government being shown to be lying, and the CDS spreads going to the moon. And of course, you know, the alien invasion of the body snatchers. So I think we reached five, what you would previously believe to be 1 in 100 year type events have hit us in 20 years. So rationally, why would you open yourself up to commercial risk? And investors are not doing it. What they're doing is they're saying, again, show me the least commercially risky enterprises. That's all I'm interested in. When I don't know if we're going to get another shutdown, I want to own treasury bills. I want to own Apple. Yeah. I want to own Google. And you tell me they're expensive. Too right, they're damn expensive. You know what? When you've got riskless securities are valued like Monet or Picasso, they are priceless. So rationally today, the world's largest investors are willing to accept modest negative returns.
This is what the bond market's telling us.
That's what the bond market's telling you, and that's what those. I think there are 5 stocks in the US stock market. Let's count them again. So we have Apple, we have Amazon, we have Microsoft, we have Tesla, and we have Facebook Metaverse. Right? They have a market capitalization of $11 trillion. The market capitalization of Japan is 9. Japan is the world's 3rd largest independent nation. You know, obviously Europe together is bigger.
That tells you a lot. So, and I think while you were saying that, the risk that just taking it from a micro level to a macro level, the risk that the entrepreneur and the corporation sees, and why would you invest in CapEx as an example, where you have no clue this
Can't pick this stuff. Yep.
it's so uncertain, the future. And that's, so many people try to figure out the long end of the curve. And they say, well, how? Is it just the Fed doing QE? But when you present the world in those terms, you can see how a money manager would say, okay, I'm going to kind of just hold my nose. And I understand that I'm going to be losing purchasing power to the rate of inflation, but I would rather have that and have kind of a defined loss and buy a 10-year treasury just to park my money, because when I look at the alternatives, they're even worse.
Yeah. So I'm not celebrating that, but I think we have to, rather than call it names, call it absurd, call it overvaluation, call it for what it is. It is a rational set of circumstances which have been caused by the failure of policymakers to create velocity speed whereby we could get back to the previous economic trends, which enriched not the 1%, but everyone.
You're right.
So now, and then you come into the world of there's a great reset. It's the future. I don't know. So maybe this is the point where inflation, we will look back in 10, 15 years time and we'll say that was the moment. Okay. And for some of the reasons that you articulate, the great resignation and everything else. But that, and this is the economy, the global economy is on a war footing. Sadly, society is at war. It's factional. We're at war with ourselves, but it feels like a war. The sums being spent are warlike in proportions. And typically history suggests that the great wars tend to be inflationary. So, there's a rational case. And so we can look back and say this was the point where things change, right? And so maybe in 5 years' time, US Treasury bonds are 4%. Does the stock market crash? My point to that is, A, I don't know. B, if you press me to call it, I'd say, I don't think so. I think those 5 stocks, they crash. Because their price they're simply priced off the fact that 10-year treasuries are 1.4. They're priced to be riskless. Okay.
Right.
And if treasuries are at 4%, people will have an appetite for risk. So like riskless, get rid of it. Okay. So I'm not interested. But how many listed stocks are there in the United States? I don't know. It's thousands. Okay. All the others, all right, they're cheap. Right, there's so many household names, blue chip, like big cap names that we all know, we've all heard of. You can buy them today at the price that prevailed 20 years ago, if not longer in some instances. So there are 5 stocks which are up here, which is just, they're $11 trillion. The US Treasury bond market, I want to say, is $30 trillion, and like you said, Bitcoin is $3 trillion.
All cryptos, all cryptos.
Gold is $3 trillion, and these are all deemed to be. I take issue with calling Bitcoin riskless, but they're in the pavilion of what's deemed to be riskless just now.
Hugh, if you don't mind, I'd like to kind of go back in time. And I was listening to your recent podcast episode where you told a story of 12 years ago, ironically enough, you went to a town in China called Wuhan. And you saw that they were building all of these real estate apartment complexes or office buildings, I'm not sure which. And you saw an issue there of overcapacity, oversupply. And you thought, maybe this is an angle from an investment standpoint, but you said that you were too early, and this got you thinking about the difference between the U.S. calendar, which is based on, or let's say the calendar of the West, that's based on 12 months, compared to the Chinese calendar that was based on 12 years. And I think you also maybe had a view back then of inflation. Because that was the first round of QE. And I think the takeaway there was you got to think that maybe that was the right trade at the wrong time. And I was just 12 years early, and maybe kind of that's what we'll see play out now, which would make sense when we're looking at this and considering what's happening with Evergrande. I don't know if you read in the papers yesterday, but they actually technically defaulted yesterday, which would be obviously a result to some degree of overbuilding in the Chinese economy, which you saw as clear as day when you were there 12 years ago in Wuhan. So can you kind of walk people through that story, and then some of your own personal takeaways reflecting back on that now?
Yeah. So I am a retired global macro hedge fund manager, and I was an orthogonal investor, which is to say, it's very windy. I've got a light. I thought it was going to fall on me. An orthogonal investor in the sense that I was a diversifying agent. You put me into your fund-to-fund portfolio, and everything, like the S&P, or today the 10-year treasury, is almost like the North Star, and everything gravitates to the North Star. And if you were to chart my returns, I'd be perpendicular. I'd be at right angles, which is to say, if you knew what was going to happen to the S&P, you would have no idea what my performance was going to be.
Right. So uncorrelated, right?
Uncorrelated. My gig was on uncorrelated returns. My gig was not to rack up the highest returns. My gig was to produce an independent set of uncorrelated returns, right? Where the carry cost was minimal.
Right.
So you had a call option on bad things, a very cheap call or put option on bad things happening. That was my gig. Because some people look at my thing and they go, "Oh, this guy, he's an imposter." Right? His returns were, I compounded at 8%, not 18, not 28, but 8. But those 8 were preciously uncorrelated to the world. So
yeah, almost like long vol with Chris Cole.
Exactly. But volatility is the most expensive thing to own, because you have to buy forward vol, and no one sells you vol at spot. They always command. They say, "Well, what will cost you?" And be like, "Oh, hit me," and you pay like 2x. And every day that nothing happens, you lose money. So being long vol is a really, really so. I was long vol, and I had a positive carry of 8. Anyway, I'm not managing money now, but that was my thing. But an orthogonal investor, I work on different influences and catalysts, and I get lit up from different sources. And so anyway, Raul from Real Vision, back in the day, he beat me. He went to China and he was walking around doing the same thing, going, "Skyscraper empty, skyscraper empty, skyscraper empty, skyscraper empty." And I thought, "Oh, I've got to go." And yeah, I was coming off the back of, I made, 31, 32% in the carnage of 2008. And in March 2009, myself and some of my team, we took a slow train. We arrived in Hong Kong. We walked over the border, and we took a slow train. Wuhan is right bang in the middle of China, and that train takes it was really slow. We slept on the train in the morning. Just culturally different society, but in the morning, people were we were sleeping on the train, and people were brewing breakfast in like Bunsen burners and pots and things, and like biting the heads off of reptiles and throwing them in the pot. And I'm like, I tell you, I would kill you if you gave me a
croissant,
croissant and a cappuccino. The reptiles, no mercy. And I published my version of Raul's on it. Skyscraper number 1. Empty. But in Wuhan, I'd never heard of it. Wuhan is a big industrial center with an enormous population. But the building that I saw, this would be a monument in downtown Manhattan. It was enormous. I know the cost of these things. This was half a yard. This was $500 million minimum sitting there. And no one, it had been built about a year. You could tell with the pollution and the windows and nothing was being cleaned. There was no reception. It sat empty from day one. And you're like, really? But, and anyway, so I came home and I launched a blow-up fund.
Yeah.
And I had the volatility was so cheap. Let me tell you as a measure of that, because we did two things. We went very long Australian 10-year treasuries. And this was towards the end of 2011. So the germ of the idea was on the train in March 2009. And by the end of 2011, I raised $100 million. And with the $100 million, I leveraged it 10x. Okay. And if it came to pass, this was my Soros moment. I was going to make $1 billion.
But the Aussie bonds were trading, wasn't it like a 6% yield or something like that?
6%, right? So, because remember, this was the 2 years after the advent of quantitative easing, which was going to be Weimar hyperinflation. And of course, Australia was, and of course, all the commodities had rallied after 2008, and the Australian housing market was still on fire. So 6%, and we're like, if China goes down, there is a lot of convexity in the price of Australian sovereign bonds at 6%. And that
you were long. So the idea there is if China goes down, then the yield, everyone's going to pile into Aussie bonds, therefore increasing the price, dropping the yield. Okay.
And another rationalization had been, I was comparing China to Germany. I was using a Neil Ferguson argument from his Ascent of Money, and he maintained that part of the problem the Germans were part of the problem after the loss of the First World War. So Germany was the China to the UK being America. In terms of the UK had been the dominant major economic force, and Germany had then adopted the Industrial Revolution 50 years later, but the adoption cycle was very, very rapid, and they were boom, the next major power. And it was like China, like when the world gets its mojo, you go to either Germany or China and you buy stuff. And so the argument was that German elected politicians at the time said, okay, we lost the war. That was not so good for us. But as sure as day follows night, the world economy is going to recover. And as the global economy starts, like not buying stupid guns and bombs, but buying chemicals and all the rest of it, we're quids in. We're going to make a lot of money. So there's an argument that Germany put its foot on the gas and said, listen, as a government, we should expand. We should build bridges to nowhere or whatever, in the anticipation of this economic rent that we're going to achieve when America comes back fully on stream, when the UK comes back fully on stream, when the consumer's buying, where there's no rationing, etc. We're gonna make hay.
Right.
Except that didn't happen. There was actually weirdly there was a deflation of 19, 20, 21. The US hiked rates and the economy hit a wall.
In the US, yeah.
And I was like, whoa, no one told us. So the same thing happened. We have to acknowledge that after the calamity of the US housing crisis in 2008, China stood up and said, we're the bridge to tomorrow. We will accelerate our spending and we will be the locomotive which allows the global economy to recover from this bad situation. And I say, well done to them. But my thesis was, what if this 2008, what if it's followed by a depression and not a V-shaped recovery? All this saving the world, you're going to be left with, you're going to be vulnerable. You're going to have spent all this money like the Germans did with the anticipation, but not enough's going to come back to pay off all your debts. That was my hypothesis.
So then the Germans back then, so then they started printing money in World War II to pay for the war, and then they continued to print money significantly. But then they never stopped, and the U.S.
They get a bad rap. They get a bad rap. Remember, the French and the Brits, and the Americans were a bit kind of, you're all European, you're all nuts. But the Brits and the French were mendacious in victory. And they're like, not only did we win, but we don't like you, and we want to keep you down. And so they took, the French took territory from the Germans, and it was rich in iron ore. But more to the point, they demanded reparations in the payment of gold.
This was the Treaty of Versailles, right?
The catastrophic Treaty of Versailles, which guaranteed the flare-up of another conflict. The Treaty of Versailles demanded that Germany had to pay gold reparations. Now, on a gold standard, gold was the money which underpinned the banking system. Banks could lend money, they could create money on the basis of their gold deposits. So as you took these reparations out, you were creating the mother of all the mother of all deflation onto the Germans. And they went, screw you guys,
We're going to print.
So, we'll print. They had no choice. The Allies could. Anyway.
Okay, so moving forward, to China. So now I understand kind of your rationale there. But moving on to China, you thought that this could happen there, and did you think that their response, if they had this deflationary wave, that their response would be money printing as well?
Yeah, and money printing can take many forms. Money printing, in that theater would ultimately end up probably being a devaluation of the currency. But what I did know, so we have the zodiac. For thousands of years, human beings have looked upon the pursuit of the heavens to kind of glean some form of abstract ideas about today. Nonsense. And in the West, we're very kind of animated. Our life is today. Our life is full of drama. We fall in love. We fall out of love. We get angry. Like, shit happens in the West. What no one told me was, I knew that they had oxes and dogs and monkeys and all that stuff.
And snakes with no heads.
Yeah. Trains to Wuhan. But no one told me, because the zodiac thing is, it takes a year for the Earth to go around the sun. And that's the premise of the zodiac and all that nonsense. The Chinese are fascinated by the rotation of the planet Jupiter around the sun. And it takes Jupiter 12 years. So things happen slower in China. And so my observations may have been relevant, but they were catastrophically out of synchronization with the rhythm of Chinese society.
But maybe they're relevant to today. That's the key. Maybe those observations, you were looking at them playing out in 2010 and 11, but maybe they're playing out in 2020 and 21.
And where that kind of has a ring of truth is the apathy in terms of the international investment community. Because I'm sure, George, you'll remember, around about 2015, 2016, there was a wobble. Asian economies really growth rates came down, and there was a shock. The system kind of had a moment. And people like Kyle Bass and others, again, came to the fore and said, whoa, this thing's going to blow. And when it blows, the Chinese renminbi, or the yuan, which back then was trading about 730 versus the dollar, is going to blow to the upside, which is a devaluation. It's going to go to 9, if not 10. And so they raised hundreds of millions of dollars, and they bought call options at those strike prices. Today, that rate is 6.34, which is to say that prediction came was again like so I began in 2011, 2012. Well, I began 12 years ago on the train. I put the client money to play in 2011. I ran it for 2 years. I timed myself out. I was like, oh, sorry, but it's not happening. Then Kyle came in, kind of did the same kind of trades. Yeah, again, way too early. And so now it's a bit like, the boy who cried wolf. Everyone's like, oh, shut up. Shut up, Kyle. Shut up, Hugh. You lost this money. And George Soros, so the godfather of macro, right? The $1 billion, sterling, trade guy. He's like, get out the water. Get out. The thing's going down, right? And everyone's like, oh, George, you're such a fuddy-duddy. You're so old. You don't understand. They're amazing. They're really, they're the future. Apathy. And so an orthogonal investor, I'm like, right angle, perpendicular. I'm like, this is interesting. Now, so in our zodiac with the 12 months and our hyperactivity, we have booms and busts. We have them all the time. Things go up, things go down. And it affects capital allocation. And it means that if there's a rogue economic agent, right, we find them sooner rather than later and we shut them down. And so, yes, there's damage, but the damage is we can live with it. Contrast that to the Confucius system of 12 years. So they've had a trend where they've been left to do capital allocation. The bureaucrats have done the capital allocation. Let's review. So I told you 12 years ago, I was on a train. I saw overbuilding. Let's review the situation today. Okay.
Right.
Because it's astonishing. So there are 50, what is the figure? There are 55 million unsold apartments or unsold, uninhabited apartments in China today.
And how many have been paid for that haven't been built? I'd even ask that question,
Let me come back to that.
On top of that, right?
That's a really good question. Let me come back to it. Let's hold on. 55 million, where no one's living in. Under construction, and to your point, paid for 93 million.
Wow.
Units. Okay. So the flaw that I made in 2009 was there was still 12 years. And over 12 years, you had enormous GDP growth. You had urbanization, and you had population growth. You have none of them now. I mean, the economic growth is coming down to 4.9, a good figure, but nothing like the 12 to the 17% figures they were doing previously. Population is now contracting and urbanization has finished. Just the completion of those existing units will provide enough housing, new housing for China until the year 2050.
Wow.
The valuation of Chinese property today is 8 times GDP. More than that, the valuation of Chinese property is between 2 and 3 times. The absolute number is 2 to 3 times greater than all of the real estate in America.
Wow. Yeah, and their real estate or construction, that represents about 20 to 30% of GDP.
Its contribution to GDP is 27, 28%. Now, the financing, where it's interesting is Chinese, I missed this, but Chinese property companies were a fantastic business, George. I should have been investing in Chinese property up until 2-3 years ago. Why were they fantastic? If I do you're the property guy, you're the expert, right? So in London, if I do a speculative condo build, I can get about 5% from prepayments from people who want to live there.
Right.
You can secure it off the architectural plans and the little showroom, and you'll raise 5%. In China, you get 100% of the funds once the building is 1/3 complete, which is to say that you are able to eliminate the risk. When you're paid for, who cares, right? There's no risk. Done. Okay. And you move on, you move on, and you move on, and you move on. So what does that remind you of, George? That is the business model of Countrywide Financial and Washington Mutual and all of the bankrupt US banks and mortgage originators from the period 2005, 2006, 2007, where the people who were supposed to know what was going on, they didn't have a frigging clue because they were too busy, like passing it on, selling it into, CDO mortgage-backed, securities. Yeah. And in that ignorance, the thing festered and got big, 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 and then went boom. Now, US house prices. So again, we work on a different system. We're hyperactive, we make mistakes, but we discover mistakes and we deal with them. And we deal with them through the mechanism of price. So in the aftermath of the problems of 2007, US house prices fell 36%.
Yeah.
And that's an enormous figure because remember, the housing stock was valued at 2 times GDP, which is to say we lost 3/4 of 1 year's GDP from that housing mistake. Now, put those numbers into China, 8 times GDP, and like the overbuild is way in excess, but let's say that the price needs to correct by the same figure of 36%. Multiply 36 by 8, that's 2.5 years of GDP that goes boom, 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 boom. So, and yet, speak to a macro guy and they're like, yeah, the green revolution, I'm buying copper, I'm short the US 10-year treasury, we're going to have inflation because of the great resignation. What about China?
Yeah. Another thing I'd add to that, Hugh, is I just did a whiteboard video on this the other day, so it's fresh in my mind. That let's just assume that does go down. So 2 years of GDP and future purchasing power just evaporates. Well, right now China is importing about 2 trillion a year, and most of their imports are, as you know, settled in dollars because a lot of that is commodity driven. So let's just say that goes down to 1 trillion. That means that there's potentially $600 billion less dollars going out into the global economy to service global denominated debt, dollar denominated debt, excuse me. And so that could be wildly inflationary because then you have defaults to those banks and their balance sheet capacity is smaller. Then they can't provide the dollar liquidity moving forward.
Nope.
And then you have this kind of feedback loop. And I haven't heard anybody talk about that in the mainstream media, CNBC, Bloomberg, to your point. They just say, oh, well, in fact, I did a story today how this, professional economist, she was looking at the Evergrande situation, the defaults, and she says, it's no big deal because the only people who owned those bonds were just some high net worth individuals in China. Like, how could you be so ignorant to the knock-on effects?
Well, I like you. So people are scratching their. So I saw a great chart today. The gap between the 10-year US Treasury bond yield and the 2-year Treasury bond yield.
I was going to talk to you about that.
It's very dear to my heart because that's where I made all my money in 2008.
And it's flattening. It's going straight down to zero.
I mean, wow! It's boom like that, to zero. And people are like, that doesn't make sense. But I'm seeing inflation today was 6.8%. This is really weird. Or the bond market's crazy. Maybe the bloody bond market is looking at China. It's the second largest economy in the world. And those guys bite the heads off reptiles, put them in pots for 12 years. They're crazy. That's some good. That's what we need to do to figure out the long end of the yield curve. We just need to figure out how many snakes
are having their heads bitten off in China. And that's gonna be our indicator, that's for sure. But yeah, I totally agree. That's the same way that I see it. But you know what's interesting about that, and I think what Americans especially really have a hard time getting their head around, is we see inflation just skyrocketing here. I mean, you go to the grocery store, you see prices go up, see rents go up, you see gas prices here in the US just sky high. So when people like you and I talk about deflationary pressures in the global economy, it's just people kind of, you get the deer in headlights. They just say, now there's no way, because my grocery bill is going up by 2 or 3% per month. But they have a hard time compartmentalizing global economic kind of deflation and deleveraging with domestic consumer prices, and those two things aren't necessarily correlated.
Well, the response to that, George, is how many nights out are you taking? Let's talk about your discretionary spending. How many visits to the restaurant, to restaurants are you doing? Because the price of non-discretionary, you are a slave. You are obliged to pay for these products and services. And if you have resigned from the labor force, or if you're one of the millions on kind of like limited salaries, you don't have much to spend for the good stuff in life. Now, I'm in St. Bart's. I see the 1%, right? They're partying like crazy. They're not the real world.
Right.
And that's what people forget. So they are justifiably angry because the things where they've got no choice, where they just have to suck it, right? They're skyrocketing. But the retort is, where you're in control, tell me what you're doing. And you're not spending money. And I know that because I can see that the banks are not creating money.
You're right. Yeah, so it's weird because you see in housing, energy, groceries, that's what you're talking about, food. You see consumer prices go up, but that reduces discretionary spending in other areas. So you can have, while you do have that large percentage of the average American's income, being spent on those three items, a larger percentage of their overall income, that could reduce the discretionary income. Therefore, the overall economic activity decreases while you have the prices of those three important items going up.
So it's relative prices, right? So non-discretionary items, without a doubt, are high, probably going higher. This is
right.
This is an Ayn Randian. This is is Atlas Shrugged? It's where does John Galt? Because
who is John Galt? Yeah,
who is John Galt? People, there is the Great Resignation. You're going to get a Great Resignation of the entrepreneurs. Like you can't prospect for oil. You can't prospect for like all the things you need for this green revolution because it's bad for the climate. Now, let's take pejorative out of it, but when you restrict supply, the price has to respond. And and sadly, there is a pejorative term, which is going to make it worse. So discretionary price inflation is, I think, here to stay. And that, again, will restrict the capacity of people to treat themselves. They're going to feel angry about that. When the French in 2018, as part of their commitment to the Paris Climate Agreement, the French found themselves, their tax levy on fuel was way below the European norm. And so they introduced steps to increase the tax on diesel. And it created the revolution in the Gilets jaunes, which was the ordinary folk, people on $1,000 a month, but needed their car, country folk, they needed their car. And suddenly you were taking like $50 out of their salary every week. And they're like, screw you, revolution.
Right.
You feel angry. And this is an angry society.
Yeah, I agree. Yeah. I mean, I just, I don't want to go into great detail. I went into it on the other channel the other day, but I was just leaving and I've got the studio here, and I'm not in it right now. I'm in my condo, but it's in Old Town Scottsdale, which is supposedly a really nice area. It used to be a very nice area. It's gone downhill tremendously. And I was just parked across the street. This was just the other night, leaving the office at maybe 5 or 5:30. And there were two guys that were walking down the sidewalk. I was crossing the sidewalk, and they came right up to me, and just I didn't say anything. The one guy says basically "nice jacket," and he pushes me on the shoulder, and then I started. I'm like, okay, these guys want trouble here, and I want nothing to do with it. So I'm like, oh, just kind of thank you, and just walking, not running, but just walking at the same pace. And the guy that pushed me, he starts backing up with me, and then he gives me a shoulder, kind of just bam, just as hard as he could, kind of right, and just knocks me back. And long story short, they were screaming and I don't know if they're on drugs, but very upset. And it's like they were just out looking for someone to beat up. And then I got in my truck, and the one guy stood right in front of me, right in front of the truck, just with his arms crossed, so I couldn't move. And then his buddy comes along the side to the driver's door. And fortunately, I was able to back up a little bit and kind of go around the guy that was not moving. But at that time, the one guy rushes the back window and tries to break it with his arm. And then I start going around him just to not hit the guy, because here in the United States, that's if you hit that guy, then now all of a sudden you're at fault, and the media spins it, who knows in what way. And then when I was pulling off, the guys just the one guy tried to break the back window, and the other guy just was beating and kicking and punching the side of the truck and screaming. And they didn't want to rob me. They didn't want to mug me. It seemed like they just wanted to hurt me. And I think that's, who knows why they were doing that. But I do know that type of anger, if that's what it was, is increasing exponentially in the United States.
I tell you, that kind of anger, I believe that is the true source of any future inflation, because that form of inflation is a breakdown of trust. It's a breakdown of the contract between you and I. It's a breakdown of the contract between citizens. We no longer accept ourselves, our place as neighbors. And inflation is ultimately like lots of inflation, not relative, but general and accelerating inflation is a price anarchy. And it comes when we have anarchy in our social relationship. And that's why, again, I had dinner on Saturday night in a restaurant in St. Bart's. And I was subject to, compared to you, a benign, but nevertheless, a violent form of repression, in that this is my first experience of it. I was denied entry to a restaurant because I lacked the medicine or any evidence.
Do they have that in St. Bart's now? They
have one
like,
particular restaurant chose to invoke that, so that it exists in mainland France, and it's a kind of high-end restaurant. The other high-end restaurants have chosen, the president here in St. Bart's is like, that's
right. Yeah, that's why I'm shocked at that.
These guys did, and it's really easy to look back from the fog of time lenses, but when the argument is, hey, I'm sorry, I'm just doing my job. I've got a family, and I don't want to lose my job, and the man says I got to do this, and the morality of the damn thing is, that's kind of like, you can justify, you can put people into gas jam. I'm not saying that, but you can justify insane levels of breaking down in social contract and trust on the basis of
Australia, Austria, Germany right now.
Exactly. It's not me, it's the man. And I've got kids, I've got a wife, I've got rent to pay. It's not me, my friend. Actually, it is.
Yeah, right.
I mean, it is and it isn't. But anyway, forgive me. My wife says
it is in the sense that subconsciously, that anger and that helplessness, or maybe hopelessness, that we feel as a society, we're going to start lashing out at one another as a result. It's the whole two rats in a cage that are being shocked experiment. Yeah.
If you want to short, so let me give you some advice. Let me give you some gonzo finance advice. If you want to take a pop and short treasuries, first of all, wait until 10-year treasuries yield more than 2%. Like, why is everyone in there? Why is everyone in a rush, right? Like US treasuries got to about 1.77% yields. Would it really, would it be such a big deal if you just said, yeah, I'm watching, but give me a closing tick above 2%. It would have saved you a lot. It would have saved the treasury bears a lot of money this year. And secondly, if you really believe inflation is going to remain with, is going to get aggravated, I fear that you will see a prominent assassination of a political figure in the United States.
You know what's scary about that, Hugh? You know what's scary about that is I just did a video, and I got this from Snider and Emil. They were talking about how just last week the Eurodollar future curve inverted. But what's I think interesting along the lines of what you just said is when it is predicting, or when it started to invert, and it's from 2023 going into 2024 through 2025, and that's the US election.
Yeah, the election cycle. Yeah. When you see the inversion, the 2's10 is more graphically appealing. I was looking at the strip and I'm going, where is it? It's inverted by like 0.0001 or something between the golds or the greens or whatever. I'm like, I don't know, but it's true. It's true.
Yeah.
And it's telling. Yeah. But thank you, George. I hadn't actually.
Just the last question, Hugh. What would you do right now if you're still managing money, looking at what's happening in China with the experience that you had 12 years ago?
I'd be short the currency.
Okay.
I'd be short the currency. I would be long. I would have. I would try and get a lot of leverage from Eurodollar options. So I think you will see. So here's a bold claim. Here's a bold and foolish claim. I think there's a tradable probability that you could see negative money market rates in the US play out over the next 2 years. In this year of plenty, and this year of, they call it boom, catch up, right, which doesn't take us back to trend.
Right.
The biggest task for the Federal Reserve this year has been preventing money market rates going negative, owing to the demand for safe treasury bill collateral. They're like, I'll lose a bit of money. I'll go negative. And the Fed's like, no. Okay.
Yeah.
So if
just to be clear, guys, Hugh's referring to what they've done with interest on excess reserves, or interest on reserves, IOR, and they took it from 0 up to 5 basis points, which is still within their range. They're not technically raising interest rates, but they're raising it to 5 basis points to prevent those T-bills going negative.
So they're offering a competing bid to the market. They're saying, keep your money in safe custody with us. We'll pay you more than market because we have an agenda. We do not want to legitimize negative rates on our watch, on our brief.
Yep.
And so the Eurodollar curve is expecting over the next 2 years about rates going up to like 1.5.
Yeah. 2023 is about 1.6, something like that. And then from 23, then it starts going down.
So imagine there's 0. into like, and China, if anything we've talked about with regard to China, began to be assimilated via risk markets, they're going to be zero, and they may even go negative. So the convexity, the return from the most unexpected set of outcomes, obviously would be very high. And then finally, I have a watching brief, nothing much yet, but so when I talked about my blow-up fund, remember back 12 years ago, I was long Australian Treasury bond yields at 6%, but I was also buying credit default swap spreads, right, on Japanese companies which were heavily influenced, whose profits were heavily influenced by economic growth out of mainland China. And essentially I could buy $1 million worth of protection of default for like, was it $25,000 or 2.5, like for nothing, right? They're still priced that way. And so if any of this comes true, George, it will be similar to the devaluation in Thailand. And I know this because of Jeff Snider. The first indication was Bank of Tokyo Mitsubishi, the biggest bank, the safest, biggest bank in Japan, and by definition, one of the biggest, safest banks globally. Their CDS spread and their interbank market, like the cost that they had to pay to borrow money from their peers from other international banks, boom, blew out. And it was because they were beginning to pick up, they had such an exposure to the Thai economy. It always reveals itself. It'll reveal itself in some of these more arcane, specialist markets. But those things are priced just now at like 40 basis points, and they could trade 1,000, 1,500. That's the kind of convexity.
So that's what would be on your watch list, so to speak, right now, if you were managing money.
And then I would have a modest short position in the renminbi. Modest because it is trending against me. And so I always need the legitimacy of trend. So despite all of this, the Chinese currency is strengthening versus the US dollar. The US dollar is appreciating against all currencies in the world, bar the Chinese. The Chinese, like you noted, 27% of their economic growth is contributed from property construction.
Right.
They have 95 million units to complete, which is insane. So that's slowing down. Their other economic engine is exports, and their currency is getting stronger and stronger. Is it a ticking bomb? I don't know. Is it a volatility machine? So at some point, things are going to reprice. I don't know when.
Yeah, right.
But I wouldn't have a big position because I like to see change. Like I said to you, if you believe in inflation, if you want to short treasuries, seek the legitimacy of price and wait until 2% for treasury yields. And for me, this has been a great, fun Friday night conversation. It's still in the realms of fantasy,
right?
But if the Chinese renminbi were to kind of weaken from 633 to like 653, which is in the scheme of things nothing, be like, ooh, that's interesting.
Yeah. Right.
The only thing where I have legitimacy to take a position today, George, would be something in the US money markets, the US treasuries. There you've got legitimacy. Everyone's kind of going, this is weird. And actually, through this lens, it's not weird. It's like, this is why. So I'd start there, and then I would wait for corroboration in market prices elsewhere.
Got it. All right, buddy. That's a fun conversation. I wish I was there in person, man, so we could grab dinner and just continue this conversation into the night over a glass of wine for you and a couple beers for me. we'll have to do that soon, man. For my viewers and listeners who want to find out more about what you do, where can they go?
I trade under the moniker of Hugh Hendry Official. You can see me hanging out with bikini models on Instagram. You can find me on Twitter at Hugh_Hendry, and my YouTube channel. I've got
podcast,
and podcasts, of course, and podcasts, and all Hugh Hendry. After this, I'm going to write a long thread on this Chinese thing, and I'm going to publish the video version of that podcast that you listened to, I imagine, last night or today.
Awesome. Thanks a lot for your time, buddy. And I can't wait to see you, man. I can't wait to get back to St. Bart's. And I just really enjoyed my time there. And everyone that I meet today, whenever they ask me about Hugh, I say, you know what? He was honestly one of the most genuine, nice people that you could ever meet. So thank you. Yeah, it's true. It's true. So thank you for your time this evening, but maybe more so, thank you for just being a great friend and being so hospitable when I was trying to find a little freedom and liberty back in 2020.
Well, you've left me speechless.
And as always, welcome to Rebel Base Camp. I'll always remember that from our first interview.
I belong.
You're always welcome.
Rebel Base Camp.
At Rebel Base Camp.
Let's take it to the top, baby. Take it to the top. Let's reach the summit. Let's put the flag on the summit.
You got it.
All the rebels out there.
Hi, guys. I'd like to invite each and every one of you to the next Rebel Capitalist live event. If you are a fan of the Rebel Capitalist show, I guarantee you will love the live event. The next one is Houston, where you can meet and listen to speakers, all your favorites from the Rebel Capitalist show. People such as Dr. Ron Paul, Chris Cole, Lynn Alden, just to name a few. If you want to check out the rest of the speaker list and find out how you can attend, we'll put a link in the description below, or you can just go to rebelcapitalistlive.com. This is an event where you can learn to build wealth and thrive in a world of out-of-control central banks and big governments. But it's not just about building wealth. It's about increasing your freedom and networking with like-minded individuals, fellow rebel capitalists. It's an amazing event. I know you'll absolutely love it. Check out rebelcapitalistlive.com, and I will see you in Houston.